Welcome to today's episode of Heard and Seen Around. I am Rajesh Karipurath. This is my take on macroeconomic and geoeconomic data points which I find interesting. I hope you enjoy watching it as much as I enjoyed curating it. Cheers.
I am not young enough to know everything. Oscar Wilde. The early bird gets the worm, but the second mouse gets the cheese. If you torture the data long enough, it will confess to anything. Ronald Coase. History doesn't repeat itself, but it often rhymes. Don't be so humble, you're not that great. Golda Meir.
A funny thing happened during the Iran supply scare. China stopped buying as much oil. Imports from the Middle East fell sharply, helping China's total crude imports drop from around 11 million barrels a day to below 8 million barrels a day. That missing demand effectively released millions of barrels for the rest of the world, cushioning the shock and preventing oil prices from turning into a full-blown inflation problem. The irony is rich. The world's largest oil importer may have helped stabilize the global economy, not by buying more but by buying less. Sometimes the most powerful force in commodity markets isn't supply disruption, it's a customer deciding that they're that hungry. Forget garages and venture capital, the AI race is now being financed by the bond market. Alphabet, Amazon, Meta, Microsoft and Oracle have already issued a record $159 billion of bonds in 2026, surpassing all of 2025 by 47% and exceeding what they borrowed during the entire 2020 to 2024 period combined. The standout, Oracle has raised $43 billion since September 2025, effectively treating the debt market like an unlimited cloud storage account. This tells us something important. AI isn't just about a technology boom anymore, it's becoming an infra boom. Data centers, chips, power and networks require enormous capital, and big tech is borrowing at historic scale to build the digital equivalent of railroads. Not long ago, a $1 trillion valuation sounded like science fiction. Now investors are debating whether OpenAI could debut above $1.5 trillion on day one. Prediction markets have pushed those odds up to 48%, reflecting how aggressively capital is chasing AI. If it happens, OpenAI won't be just another IPO. It would instantly join the ranks of the world's most valuable companies. What's remarkable is the speed. The market has gone from asking whether AI is real to asking how many trillion-dollar companies it can create. History suggests investors occasionally get carried away. Then again, history never had AI writing code, creating videos, and answering questions at scale. A decade ago, oil traders watched Washington and Brussels. Today they watch Beijing. The world consumes a staggering 104 million barrels of oil per day. But the demand engine has shifted. Non-OECD companies now account for 59 million barrels per day versus 45 million in the OECD, while Asia Pacific alone burns nearly 40 million barrels a day. Here's the catch. China's imports are sitting near 8-year lows, helping keep oil prices surprisingly calm despite reports of 1.2 million barrels of missing supply and inventories approaching multi-decade lows. Markets see weak Chinese imports and assume weak demand. That's like judging a supermarket by how often it restocks while ignoring what's already in the warehouse. History has a habit of humbling parabolic moves. Gold has surged an extraordinary 435% over 11 years, climbing from roughly $1,046 to $5,600. Every previous major gold bull market that reached similar extremes eventually suffered a correction of at least 25%, and in some cases much more. The interesting question isn't whether gold can correct, it's whether today's market resembles the 1970s. Back then, gold was emerging from decades of price controls. Today, the drivers are central bank buying, geopolitical fragmentation, and concerns about fiat currencies. A 25% pullback would take gold back towards $4,200, which is where it is now, which sounds dramatic until you realize it could merely be following a historical precedent. India's FDI numbers look better at first glance than they do under the hood. Yes, inward FDI recovered to $40.8 billion in FY26, but the net FDI was just $6.9 billion, down dramatically from $44 billion in FY21. Why? Because Indian companies are investing abroad at record pace, with outward FDI hitting $33.8 billion. There's another wrinkle. Of that $40.8 million of inward FDI, only $11.1 billion was fresh equity capital. The majority, $25.7 billion, came from existing foreign companies simply reinvesting profits. That's a vote of confidence in India, but it's not the same as a queue of new global investors arriving with checkbooks.